Wealth Nation, today we hope to knock your socks off by bringing in another subject that is near and dear to our hearts, and that is reverse mortgages. So, who knew that reverse mortgages can be an asset and can be leveraged properly to instill your family's wealth? My name is Carmen.
And I'm Darius. And my first introduction to reverse mortgages, I wouldn't say was a good one because of my preconceived notions or misunderstandings about this idea. And a lot of it was the fact that I thought that like my parents, once it was introduced to my parents, that they were going to lose the house and it'll no longer be in the family. But today we have Mr. Don Graves that's going to debunk all of those false ideas that I had, so that we can better understand this process.
And before we bring Don on real quick, I just want to let you all know, we learned about this strategy in the What Would the Rockefellers Do book by Garrett Gunderson. We had the opportunity to write the foreword. So if you are interested, click on the link below because we can send you this book for free. You just have to pay for shipping. And it really talks about how to preserve wealth and how to maintain properties and keep them in your families. So without further ado, we are welcoming Don Graves, who is the man who is going to really shed light on how this product can be used to preserve your wealth. So welcome, Don, to the Wealth Nation channel.
Oh, thank you, Darius. Thank you, Carmen. What a joy. I've been following you all for years. I took your master class regarding YouTube. I've just been a secret admirer. and so when we got a chance to be introduced a few months back, oh my gosh, my heart just swelled up real big. My big toe swelled up. And I thought, man, this is fantastic. And so I'm tickled and honored to be able to speak to Wealth Nation and your family.
Oh, thank you, Don.
Thank you.
So Wealth Nation, what was actually really interesting, and we know that this was completely God sent, was we read about reverse mortgages. We spoke to an individual in the industry and said, hey, do you know anyone that knows the reverse mortgage, product and has high integrity and is, a master in the game? And they said, oh yeah, you have to contact Don. So I think I emailed Don and instantly you responded right back and you're like, I already know you guys. What do you need? I will totally help you. And I was like, I think my mom needs some help. This is a perfect opportunity for her. My mom's 76 years young and she still has a balance on her home and is trying to figure out income in this whole thing. And immediately we met with my mom, Don, and it's been an amazing conversation, and your team has been so helpful and super responsive. And the idea is, by the end of the year, we can get my mom into a reverse mortgage, but we'll keep you all posted on that. But anyways, let's get to the number one question, Don, that everybody has, which is, why are reverse mortgages misunderstood?
I tell someone said, Don, I said, have you ever been to a family gathering and someone mentioned reverse mortgage? Maybe like, hey, I'm thinking about getting a reverse mortgage for mom. What happened? Three people dove under the table. 3 people ran off, and your aunt Janie made a shank out of a plastic knife in the corner.
Yep.
I mean, isn't it just dangerous to
Right.
reverse mortgages in mixed company? And so I'm in my 25th year of doing reverse mortgages. It's all that I do. And in those 25 years, I've had about 16,000 consumer-facing consultations, and around 3,000 people became my clients. And that tells us 2 very important things. Number one, I've talked to a lot of people. And number 2, I know it's not the appropriate resource for everybody. As a matter of fact, I've told more people you shouldn't do it than I've encouraged to do it. But the program, and we'll see this when I jump into my mini master class, it's been around a long time. It's in 19 countries, and the U.S. was one of the last ones to get in. And that was in 1961. Came to the United States, became part of the federal government's program. FHA sponsors the program in 1988. So 36 years of having this. And over the time, I just recently wrote an article in Retirement Daily that talked about how did reverse mortgages get such a bad reputation. And I said, well, I'm in the early days, the Wild West, and you guys, you understand because you're in life insurance or in annuities. What product didn't have a bad reputation? Or there were some people who used the product in the wrong way, or there were some bad actors in the industry. So reverse mortgages are no different in our existence, that people misuse them. And I'll see if I can put this link up in the comments so people can see the article.
Sure.
But people certainly got the money, and they spent all the money and didn't have money for taxes, or they were bad actors in the early days. So someone has heard a bad story about a reverse mortgage somewhere. And it usually goes like this. You're at the barbecue, and Uncle Junebug comes out of Tracy's spare bedroom. And everybody says, Uncle Junebug, what's going on? And he says, I moved here to Tracy's house. And everybody says, what? And he said, well, what happened? And here's what he said, Darius. He says, oh, I got that reverse mortgage, and I lost my house. And you know what happened? Everybody at the barbecue said, I knew it. I knew it. And on Sunday morning, they went to church, went up and told the deacons, you got to announce this. Monday was at the beauty shop, Tuesday, the barber shop, Wednesday, the Kiwanis meeting. And by the end of the week, someone knew somebody who had an uncle, had a cousin, had a grandfather who got a reverse mortgage and lost his house. We've all heard that story. And then they come to me, or they come to you all, and they say, what do you say about that? And I say, it's 100% true. Don, you're the evildoer. I said, no, it's 100% true. Uncle Junebug got a reverse mortgage, and he lost his house. Now, he didn't lose his house because of the reverse mortgage. He just didn't tell you the whole story.
Oh, speak on it, Don. Speak on it.
So the whole story was that Uncle Junebug hadn't paid his property taxes in 4 years. And I don't know, unless you're a Wyoming homesteader, where you're going to live in the United States where you can live anywhere and not pay your property taxes. They're either going to be sheriff's sale or tax lien sale, but your house was going to be in jeopardy. So that's the number one way that reverse mortgages showed up in the newspaper about somebody losing their house, but they didn't tell the whole story. And so hopefully today we can dispel some of those misconceptions and talk about what's different, what's changed, and why everybody, and I believe this is my I have a dream speech part, why everybody who has a family member over age 62 needs to have a cursory knowledge of the reverse mortgage subject matter in order to, at a minimum, factor it out a mom or dad's or their aunt's equation. And so I'm tickled to be able to talk about that today.
Thank you, Don. It's that simple, right? And exactly what you were debunking, Don, it just speaks to like every product in the financial industry, right? If you leave it up to the public, every product is scammy, is out to get you and all of that. And it's just because we miss a piece of that puzzle. And it's probably because we weren't using the product responsibly, which is why what happened, however it happened.
Yeah. And it's because of everybody had an uncle, cousin, aunt, uncle, grandpa.
Like you said, Uncle Junebug. So, but before we jump into your presentation, Don, we got to give your plugs, right? So, Housing Wealth, right? We're going to leave this in the description. So this is written by Don. Fantastic. He sent it to us himself. We read it cover to cover. It's amazing, simple and easy to digest. That's the big thing. We always promote books where like we feel like we read it and we understand, right? You're not speaking over people's heads. You're just speaking straight to our heart and getting the facts so that we can make informed decisions. And then the other one that you sent me, the Retiree's Guide to Housing Wealth. Phenomenal. Absolutely get these books as soon as you possibly can. All right, Don. So let's move over to your masterclass, right? Because you're going to guide us through basically how you would help other people better understand that this product of a reverse mortgage if they're inquiring about it themselves, right?
Today, I'm going to do a mini masterclass because I didn't want to launch some of the videos today. So it'll be a mini masterclass. But to see the full masterclass, can I give the website to your audience?
Please.
Absolutely.
It's www.housingwealthmasterclass.com. Again, www.housingwealthmasterclass.com. And so you can go there, see the whole thing. And I got that idea from Carmen and Darius. I didn't have that 3-4 years ago, and it was you all, and I saw what you were doing, and I said, "Oh my gosh, 21 years, and I didn't have this." So I think about you all every day. Just thank you so much for your contribution into the earth.
Yeah, absolutely. Yes, our pleasure. All right, Don, so go ahead and share your screen and we'll pull up your presentation.
Okay.
All right, Don, take it away, my dear. Today
we're going to do my mini masterclass, how to how to use using your home to dramatically improve retirement outcomes without losing ownership or giving away your children's inheritance. and that's
Whoa.
that's what people think. And so I'm Don Greaves. I'm in my 25th year of doing this. I've got some credentials on the screen. I'm an adjunct instructor at a college. I'm a subject matter expert. All these things, nice things people say about me. I've written 3 books. That's just the blah blah blah. So I want to jump right into this. That the face of retirement is changing. The face of retirement is changing. I love these folks right here. And sometimes I'm at a meeting and I'll say, anybody know who this is? And if they're young, they'll say, Aerosmith. Another guy said, no, man, that's Journey. I said, wrong, boys. These are the Strolling Bones.
Strolling Bones.
I said the Rolling Stones have gotten really old in our lifetime, but they're the face of the baby boomer generation. They're going to live longer, be highly indebted, and have not saved enough to sustain a retirement that's going to be longer than most people expected, less predictable, and more expensive. And so the face of baby boomers here, and when we talk about retirement planning, the landscape is, for most people, retirement was, I'm going to climb this mountain and allocate my money and manage my risk. And at some point, I'm going to get to the top of the mountain, plant my flag, take my stance. Now I've got to come down the mountain. And that's where the danger lies. See, there are 18 major risks in losing all of your assets or running out of money early, coming down the mountain. And so that gave way to a new moniker, not retirement planning, but retirement income planning. What do I do with my money? When do I spend taxable, non-tax, tax-free dollars? What ordered when, how, managing risk, all of that we have a safe landing. So the landscape has changed and the risks are real. See, today's retirement, as I said earlier, will last longer, be more expensive, and less predictable. Do you remember the first time, and Darius and Carmen, I'm older than you all, but do you remember in your youth, the earliest gas price you can remember? Maybe it was with mom and dad or somewhere, and gas was how much? What's the earliest you remember?
97 cents.
Yeah, right. It's not that now, is it?
No, not close.
I remember.
We got a 3 in front of it.
I remember my dad screaming that gas had gone up to 29.9. 29. He couldn't believe it. He was mad. He 29.9. Now, I'm Kentucky simple, folks. Daddy's from Falmouth, mama's from Winter. But he's screaming 29.9 and at Sunoco. And he gonna drive 45 miles to Clark's because it's 25 cents. Now,
Oh my goodness.
now, mama's still alive. She's 92. My stepfather's 95. Aunt Ethel died at 102. So retirement's going to last longer, be more expensive and less predictable. But the resources at retirement are limited. 3 primary resources. Now, here's a question you all are viewing. I said, is it important to use all your available assets when you're planning for retirement? I would hope that's a resounding yes. But most people have 3 primary buckets. You've got your income bucket, employment, Social Security, pension, if you're lucky. You've got your investment bucket, 401ks, brokerage accounts, IRAs, things of that nature. And then you've got your insurance bucket. Your insurance bucket includes fixed and variable annuities, life insurance. Now, all of these buckets have a spigot on them, and you can draw money throughout retirement because you're going to need it. You're going to need it because emergencies are going to come, expenses are going to happen, enjoyment, things you want to do, and then erosion. Erosion means, what are the taxes going to be? What's inflation going to do? What's market volatility? But there's a 4th bucket. 87% of retirees have a 4th bucket. That's called your housing wealth bucket. And folks, this is not a surprise. You've used your housing wealth already. If you're listening to this, that when you didn't have cash to buy your first house, you leveraged and you used the bank's money.
Totally.
When you needed to send the kids to college or do a home repair, do something, you got a home equity loan or a line of credit, so you didn't have to take from your savings that were building up. But now when we cross over into retirement, what's an age-appropriate equity release strategy? Well, reverse mortgages really fit into that category, but using the house is not new because most of us have already done it. So is it important to use all your available assets when planning for retirement? Absolutely. Should anything be excluded? No, absolutely not.
Use what you got.
See, the housing asset, This is the U.S. Census Bureau a few years ago, said that the average retiring couple, age 65, has less than $100,000 saved, but they have a home that was $200,000. That 68% of their total wealth was in their housing wealth. Now, this has been updated because home values have just shot up since COVID. And so, but the majority of wealth in America is tied up in housing wealth for retirees. So what do we do with that? Those who are listening, what do we do with that? A recent statistic, a survey was done that it's now, this says 13 trillion, it's now $14.2 trillion in unmonetized senior home equity.
Wow.
That is, we don't have to face retirement without using all of our resources.
100%.
So let's talk about how do we do that using the home. I'm going to give you 3 discoveries today. Number 1, it's just a mortgage. When we talk about reverse mortgages, it's just a mortgage. Number 2, it's not a last resort. And number 3, it's more than a television commercial. Now, before I get started, because I don't want to just yak away here on the front porch, Carmen and Darius, would you like to interject anything or ask a question before we jump in?
No, well, I love the slide that you had about the buckets and the spigot on the buckets, right? Because I almost feel that sometimes people get to a point where they this nest egg mentality. And that the nest egg mentality is like, I'm just going to sit on this nest egg and I'm not going to leverage it, do anything with it. And I think you illustrated such a beautiful way of looking at all of these assets that we've been building all of our lives, right? And now we're at the prime time to be able to leverage them and use them to our advantage. So I loved how you broke it down into income, investments, and insurance, and also housing, because a lot of times what we find is, especially our baby boomer clients,
people only get to really only focus on the first 2, income and investments.
Yeah. And they're looking to us to say, what about this insurance thing? And then also, what about my house? Like, how can I tap into my house? So we're hold your horses. We're getting into that in just a moment.
I think what we're going to see is that I tell, because most of my time is with financial advisors, and I say to them, you're a AAA advisor, aren't you? And they think I'm talking about the car insurance. They say, what's that? I said, you're using all of your clients' available assets, AAA, to create a retirement income plan, right? They say, I think so. And I said, well, tell me how you're using housing wealth. And most of the time, it's not in a proactive way. It's kind of as a last resort. And that's what we're going to kind of talk about today. And so it's not a last resort. So let's jump in. What is a reverse mortgage? Folks, it's 4 letters, IJAM. I used to play in the band when I was younger. IJAM. Now, what does that stand for? Hey, it's just a mortgage. It's just a mortgage. Don't make it spooky. Don't, where I grew up, Kings Island was in Ohio. They have them all over. And you remember, Carmen and Darius, if you go to the amusement park, there's that part of the amusement park, Scary Land, right? The haunted house. And they said, don't go in there. The last little girl went in there. She never came out. And so in the amusement park of financial products, reverse mortgages tend to want to go over in the spooky land.
Yeah, for sure.
I said, no, this is over here with the Ferris wheel and the merry-go-round. It's just a mortgage. It's a home equity loan for retirees age 62 or better that allows them to convert a portion of their home's value, turn it into tax-free dollars. I said, you've heard that before, right? You've ever got a home equity loan or home equity line of credit? Sure. You leveraged your home. The bank loaned you some money. You did things that you wanted to do with this. Now, the difference is a reverse mortgage is a non-recourse loan. I'll cover that in a minute. And it's age restricted. So somebody has to be age 62. The other person in most states only has to reach age 18. So you could be 70, have a 20-year-old husband, and get a reverse mortgage. No judgment. I've seen strange things. But listen, folks, it's a home equity line of credit for retirees, allows you to borrow money. You do not give up ownership or come off title to the home, and you don't have to make monthly mortgage payments. Now, how many folks have heard the story? Oh, that reverse mortgage, that's the deal where the bank loans you the house, and when I loaned you the money, and when you die, they take the house, right? That's a common phenomenon, a misconception. I said, ooh, I wouldn't want to be involved with that. I said, no, IJAM. It's just a mortgage.
It's just a mortgage.
We don't take the house. And the reverse mortgage, I said it in the beginning, started in 1961. The home equity conversion mortgage, you'll hear me say the word HECM, HECM, is the federally insured version. About 98% started in 1988. The jumbo reverse mortgages started in 2000 when I started with Lehman Brothers, and then the Heck for Purchase, a way to buy your next home using a reverse mortgage, was in 2009. So when we talk about a loan, any loan, home equity loan, the question was, Don, how much money can I get? So I asked the lady, I said, well, when you went and got your home equity loan or line of credit or whatever loan, or even a credit card, how did they determine how much you were able to receive? She says, I don't know. I said, well, they looked at a square. They looked at your income, your assets, your debt ratio, and your credit score. And based off of that, they say, hey, we're going to loan you this amount of money at this interest rate. Now, and when I say we, I mean the Federal Housing Administration of the United States Department of Housing, doesn't look at that. Look at three things. So listen, folks, if you're watching this, grab you a piece of paper, because I'm going to share some things. I'm going to ask you to draw a few things, but the triangle is going to be the most important thing today. So draw a triangle. And so to determine the amount of money reverse mortgage makes available, number one, it's based off your age. The older you are, the more money you can get. Number two, the value of your home. And number three, the future projected interest rate, which the federal government calls the expected interest rate. So these three things go into the HUD's formula, and we get a number in the middle of the triangle, and that's called the net benefit amount. That's how much money, net money, the reverse mortgage makes available. It has to be a first mortgage. So any mortgages, home equity loans, lines of credit have to be paid off from that. So under the base of the triangle, we subtract outstanding loan balances, and what we're left with is called a line of credit. A line of credit. So Carmen and Darius, age, value of the home, interest rate gives us amount of money. We pay off whatever may be against the house. 6 to 8% of retirees have some sort of loan payment coming into retirement, and what's left over is the line of credit. And so that's how we determine the amount of money. Don, when does the loan become due and payable? When it's no longer the primary residence. So when the last surviving borrower permanently departs the house, they move or they die, or they've gone into a facility for 365 consecutive days because of physical or mental incapacity, the loan is going to become due and payable.
Okay.
Typically what happens is 98.7% of the time, the heirs sell mama's house. They pay off whatever the loan balance is, and 100% of whatever remains passes on to them. So if mama had a $400,000 house when she got the reverse mortgage, she died, the house was worth $800,000. And her loan balance, I don't know how much she used, but let's say her loan balance is $300,000. Let me go back. And so now mama's died. She's got $800,000 house. Her reverse mortgage loan balance is $300,000. The kids sell the house, pay it off. There's $500,000. There's $500,000 left over that goes to the heirs or the estate. Well, Don, they don't have to do that, do they? No, they may have life insurance. They can pay off the house. They can refinance it, but typically it's sold. But the main thing is 100% of any remaining equity goes to the children. So the four nevers. You never give up or come off title to the home. You never owe more than the home's value. You never have to leave the home if you spent all the money down at the riverboat. And you never have to make loan repayments in advance of leaving the home. So those are the basics of the reverse mortgage, folks. It's just a mortgage. It's just, I go into a few more details in the masterclass, but it's just a mortgage. It's just a mortgage. Darius, Carmen, before we go to it's not a last resort, anything you want to talk about right there?
Yeah, tell me how it works with a life insurance policy, because most of our listeners do understand the concept of using or leveraging whole life insurance. So let's say we have someone that is doing a reverse mortgage, and the collateral for that is going to be the life insurance policy, but they go into a retirement facility. Now, after 365 days, the money is due back. You just take the cash value from the life insurance policy and repay the loan, correct?
You could do that. Absolutely.
And then also too, if the individual passes away, you could use the proceeds from the death benefit to pay off the reverse mortgage, correct?
Absolutely.
Okay.
Absolutely. Thank you. Great question. So number 2, it's not a last resort. Now, this was popularized by the financial regulatory. Oh my gosh,
Regulatory.
Oh, thank you, Carmen. You've. It's the Kentucky in me. I'm used to sitting on the porch and sipping sweet tea, and every time I have to use the big words here with folks like you, I get all stumbled up.
Not at all. We're working with our 4-year-old with phonetics, so we're going through the syllables. So yeah, I got that one down.
Send me the Hooked on Phonics. At 59, I still. My wife gets embarrassed when she says, "You so country." I said, "I am."
That's what makes you.
But FINRA popularized this idea that reverse mortgage should only be used when you've run out of investments and savings, and that was just wrong-headed. It was, and so let me go back, and they changed that position, by the way, to 2013. A task force I was on with Dr. Barry Sachs and others went to FINRA and says, why do you write that reverse mortgages should only be used as a last resort? And they explained to them what you're going to see here, and FINRA changed their position.
Beautiful. There you go. Making change, Don.
Because of this line of credit. Now, the reverse mortgage line of credit, I call it the Swiss Army knife of retirement income planning. That, let's look up here. On the left-hand side, you'll see ages 65 to 95. On the right-hand side, you'll see home values, 400,000 to $1 million. So let's take a client who's age 65, and they're in an $800,000 home. Now, this changes every Tuesday, but to give you an example. So they're able to get a reverse mortgage of $267,600. I'm going to try to use this laser pointer. Here we go. I think that. See that? 267, 600. Now, this is the growing line of credit. If you're writing, write down GLOC, growing line of credit. Now, remember, my family's from Kentucky. They always think I'm talking about some sort of firearm when I say a Glock. And I said, no, it's not that type of weapon, but it's a financial weapon. And so now 267,600. Now, notice, if you don't use that line of credit, 20 years later, how much has it grown to?
We got $1 million.
$1 million. 30 years later, 1.9 million. Now, this is what I'm doing in my own personal plan. But what I want to focus on is that the reverse mortgage is a growing line of credit. Now, most people don't know that. And I said, if I told you you've got 3 buckets in retirement: income, investments, and insurances. I said, but if I told you you've got a 4th bucket that has $2 million in it, most people would say no. I said, absolutely. You've got a bucket that's got more than $1 million in there. And with that bucket, now that can take pressure off the other buckets because you have options on what to do when an emergency comes up, an expense, enjoyment. We had a lady spent $10,000 to go on a vacation. And she took that out of the wrong bucket. She took that out of her IRA taxable bucket. And what happened? Her Social Security now was being taxed at the highest level. She had some capital gains that year, and she was under the threshold. But when she took that $10,000 out, it pushed it over a threshold. Now that's being taxed at a different level. So her $10,000 taken out of the wrong bucket was very, very expensive. And so having this reverse mortgage line of credit takes pressure and gives you options for your retirement. So I call it a RELOC, a retiree's line of credit, or a HELOC. Yeah. And every now and again, Derry, someone will say to me, Don, I can always get a home equity line of credit. I can always access my home's equity. I said, no, you can't. In the year 2000, when COVID hit, five of our top banks, Wells Fargo, Chase, Citi, Bank of America, and there's a 5th one I forgot, they eliminated their home equity line of credit program. You couldn't get a home equity line of credit. They absolutely eliminated it. Wells Fargo, at the time of this recording, you still can't get a home equity line of credit because of COVID. 2 banks came back in 2024. A few more came back. And so I say, no, your home's equity is not always accessible. So let's think about this. 87% of your listeners live in a home. They're sitting on their biggest asset. And I got in trouble one time, Carmen. I was at the Baptist church, and I said, Mrs. Jones, you got a big asset. And the deacons came, and they took
You had to go in the back room and have a conversation.
Oh, no, I didn't mean it like that. Right. I just meant Miss Jones had a home, big home.
Oh, done.
So I stopped using
Not at the Baptist church.
Well, I don't say big asset anymore. Though I told my wife I was going to make a T-shirt that says "Use your big asset," and then my son said, "Why don't you make one that says tap the asset?" And I said, "Son, stop."
No, you have to, because that's going to get people interested. Tap the asset. I like it.
Tap that asset.
I I would wear that shirt. I want that shirt, Don. Send it to me.
One of your listeners just dropped off the call. They said, I'm not listening to this fool anymore.
No, not at all. Our peeps can get it. They wear our shirts.
So I didn't do that. I didn't, because I didn't want to have to come repent on Sunday morning and just say, I'm sorry.
Oh, I love it.
So listen, I said to the person, I said, now, if you had a choice, would you rather your home's equity be liquid or locked? And they said, well, liquid.
Liquid.
I said, would you rather it be growing or stagnant? They said growing. I said, if you had the money, you got a home equity line of credit, would you rather it be cancelable or non-cancelable? What does that mean? That means every home equity loan or home equity line of credit that's issued in America has a clause that the bank, the lender, can freeze it, cap it, cancel it, or reduce it. The reverse mortgage, this growing line of credit, cannot be frozen, capped, canceled, or reduced. If you took the money out, would you rather have a mandatory payment the month following or make it a voluntary payment? Would you rather have it insured or uninsured? Folks, listen. The reverse mortgage line of credit, the RELOC, is uniquely positioned for the retiree. It's uniquely positioned for you to access your home's equity, use those dollars in a proactive way, and particularly when you're working with Wealth Nation and Carmen and Darius and their team, they're going to help you implement all four of these buckets in a way that's going to create some opportunities that you may have never imagined before. So it's not a last resort. Now, before we go into our final point, anything you want to talk about here when I talk about it's not a last resort?
The point that you made about the HELOCs, I think is a very strong point, because we still get people to this day, and not that it can't happen, to your point, right? But the financial climate has changed. And I think HELOCs have been something that's been so sexy and maybe potentially accessible in the past. And now it's just become even more difficult. So even though you may be able to apply for a home equity line of credit, you have to remember you're still applying for it, right? Just because you have the equity in your home doesn't mean that you're going to be able to access that. So I love the fact of having a RELOC and thinking about this from a completely different perspective. I mean, this gets me so jazzed. I wish I was 62 so I could start taking advantage of it.
Oh, no worries, coming.
I know. Don't speak too fast. But the point is like, this is an amazing asset where you can tap that asset, right? So that you can really leverage that financial freedom.
Stop it.
In your retirement. I love it, Don. I'm telling you. I'm making a t-shirt.
I had a t-shirt that was shot down by the committee, which is my wife and friends. Don, you can't do that. I said, that's a great t-shirt. Anyway,
It is.
It's just a mortgage. It's not a last resort. And it's more than a television commercial. Now, most people, and when they think of reverse mortgage, you've seen Magnum PI or Fonzie or one of these people, and that's great. That's great. But you can only cram so much into 60 seconds. Maybe it goes 90 seconds or 2 minutes. And this is more than that. I want to talk about some strategic uses. I didn't show it here, but in my master class, there's an episode of Family Guy that is hilarious. Yeah. Oh my gosh. And Peter goes to the flea market and he wants to get a Mr. Potato Head, and it's $600. And Lois, his wife, says, we're not spending $600 on a Mr. Potato Head. So he's sad. He's laying on his couch, and the son says, "What's wrong, Dad?" And he says, "Oh, Mom won't let me buy a toy." And he turns on the TV, and it's a reverse mortgage commercial. He gets a reverse mortgage and buys this Mr. Potato Head. And it's all the common mythology and misconceptions, and it's hilarious. Now in the full master class, I show the video, and but www.housingwealthmasterclass, www.housingwealthmasterclass.com. Go there, check it out. Let me give you. There are 52 strategies. The books that Carmen held up. Can you hold up the Retiree's Guide again? 52 strategies that reverse mortgage can help strengthen your retirement outcomes. Now, most, if not all, retirees have Social Security. It was designed in 1935 to cover 35% of your retirement income needs. Now, most people use it, and it's not 35%, it's 50%, it's 75%. It's a big part. And someone says, "Don, I don't need a reverse mortgage." And I say, "You probably don't." I said, "You probably don't need Social Security." Well, I do. Well, of course you do. You take it. And I said, "You don't need a reverse mortgage. But when you discover what it can do, you may want it." I lived in Africa for 3 months in Kenya, and I discovered I didn't need air conditioning. I didn't need ice. I didn't need toilet paper. I didn't need electricity. I didn't need a stove. But when I got back to the US, I started using all those things and I was glad for it. So these are things you may not need, but optimizing Social Security, choosing the right Social Security strategy is one of the biggest financial decisions you'll ever make in retirement. There are 567 ways to claim Social Security, and not all of them yield the same result. The wrong claiming decision can leave up to $250,000 of your money with the government. That's why if you're listening, work with a trusted advisor that knows this or know where to resource this. So I wrote an article called 7 Ways to Improve Social Security Planning with a Reverse Mortgage. And I used this line of credit. So see on the screen here, this person had a line of credit, $224,000. And on the left-hand side, I just show it growing.
Mm-hmm.
That's column A. Column B says, in any given year, can I turn that into a monthly payment? Sure. So at age 65, if you had $224,000, and you say, hey, Donna, what's the monthly amount? I said, I'll send you $1,056 per month. Or 5 years, you say, I'd send you $4,000 a month. So here's your financial flexibility. I can have 50 conversations from this one page here. But let's talk about just Social Security. Sometimes it's just not enough.
Yeah.
And say, Don, I need more.
Mm-hmm.
And well, that's where your housing wealth bucket comes in right there. You can nibble off of this to get a little bit more to supplement your Social Security. You can defer your benefits. Don, if I wait from claiming at 62 to 70, right, that's going to be so much more money. But what if I need some money during the interim period? Use your 4th bucket. Cost of living increase at the time of this recording is going to be 2.5% next year. Yeah. But some people realize that, well, wait a minute, my personal inflation rate was more like 8%. My donut doesn't cost what it used to. I went to Whole Foods. That was my problem. I had to go pick up a piece of salmon 2 nights ago. I just couldn't spend that type of money. I need to go to the Piggly Wiggly, get me something on sale.
There you go.
Taming the tax torpedo, which is if you take too much provisional income, your Social Security is going to be taxed. Managing IRMA, income-related monthly adjustment amount shocks. I had a client that they were taking out $500,000 because they were going to do something. And I said, you understand when you do that, your Social Security, Medicare Part B and D, one of them's going to go from $164 to $600 a month. The other's going to go, I said, you're going to be spending per couple, an extra $600 a month. 2 years from now, that's going to kick in because of this IRMA deal. They had no idea. The advisor didn't know. Replacing income after the death of a spouse, and then enhancing emergency funds. All of these conversations, look at that screen that says everybody's getting Social Security. Having a reverse mortgage line of credit to be able to do some of those things just gives you options and optionality. Number 2, managing mortgage payments in retirement. Oh my gosh. I don't want a mortgage payment. I'm going to have one in retirement. I'm going to do a strategy that I'm going to have a voluntary one. I'm going to get my reverse mortgage in 3 years, 10 days, 3 years, 10 months and 15 days. I'll get my reverse mortgage.
Just counting.
I'll be 63. My wife will turn 62. But managing mortgage payments, listen, those who are listening, here's a question. If eliminating a monthly mortgage payment meant your retirement savings could last significantly longer, would you want to see how it works?
All day long.
All day long. Now, most people watching this, you said 1 or 3 things. You said yes, how, or that sitcom I watched as a kid, What You Talking About, Willis? You said one of those 3 things. Let me rephrase it. If you didn't have to, what difference would it make in your retirement, your sleeping, just your life, if you didn't have to make a monthly mandatory mortgage payment? Oh my gosh. A lot of times I ask that question. I say, what would retirement be like if you didn't have to make a mortgage payment? I don't hear a word. I hear a sound first. You know what sound I hear, Darius?
Like a
That's the sound I hear, right?
Mm-hmm. Well, Don, I want to make sure our viewers are tracking because you asked such an important question, and I just want to make sure that it sinks in. But we just need to ask that question again. Okay. What if you could eliminate your monthly mortgage payment?
Mm-hmm.
right? For all of my baby boomers out there, just think about that. Sit on it for a minute, because before today, you may not have known that that was even an option.
Right.
Right? We didn't know it was an option. I didn't know that it was an option for my mom, and she completely qualifies for this. So the minute you asked us that question, I was like, I'd be damn.
Yeah.
What? Like,
Yeah.
and we're in the financial industry, right? And we drank that juice about this being not a great product because we heard through the barbershop and the beauty salon and whatnot, that whole thing.
Mhm.
But as we got the facts, we recognized, no. Like, don't sleep on this, because this is a conversation of being able to visit your grandchildren during the holidays as opposed to sending a card.
Mhm.
Right. This is the
Absolutely.
difference between being able to have wine at dinner when you go out to eat, or having water. Right. That this is the difference of scarcity and abundance mentality as we're thinking about your retirement. Because I know so many of our families tend to get into that scarcity mode because all of a sudden they're just thinking, I have a limited income. Right. I have a fixed income, and now this changes the game. So I just want to make sure we really hone on this point.
Yeah, and I would say the other piece to that is by eliminating the mortgage payment from a parent, it also eliminates it from the child.
Yeah.
Who is contributing to that parent.
Right.
Sure.
Right. Thinking about the children who are trying to help, the parents keep the home or support them. This just gives everybody a big sigh of relief.
Right.
It can. And you're right. Both of you are right. If you ask the average person in the grocery store during the Christmas shopping, and you said, is there such a thing as a voluntary mortgage payment loan in America? No, I don't know anything like that. You always got to pay something, at least interest only. Most people don't know. I said, no. So Steve and Barbara here on your screen, they're prototypical here, $500,000 in an IRA, and they're retiring. And they say, well, we're going to take $30,000 a year. That's our desire from that initially. That's pretty aggressive, Steve and Barbara. Now, they've got a $200,000 mortgage, and they're paying $1,500 a month principal and interest. So their concerns are, am I going to run out of savings in my lifetime? I'd say probably at that current level of lifestyle. And or am I going to have to cut back? So they went to their financial advisor, and they said, the advisor asked them the question, Steve and Barbara, I'm curious, he said. I see you're already making a monthly mortgage payment. And he said to them, if you had a choice, would you rather that payment be mandatory or voluntary? What would you choose? And they said, duh, voluntary, of course. And he said, would you want to see how that works? And he introduced the reverse mortgage concept through our team. And I give leadership to a team about 200 across the United States. And so we drew that triangle I talked about. So based off their age, home value, expected interest rate, $224,000 was available to them. The first thing it did is it paid off their existing mortgage. Remember, they had a $200,000 balance, and it left them $24,000 in a growing line of credit. Now, let's see, how did this help them? So their concern was, I don't run out of savings. I want to maintain my lifestyle. So when they did a reverse mortgage, benefit number one is they eliminated that $1,500 principal and interest payment. Stop right there. Those who are watching, if you just eliminated a mandatory monthly payment of $1,500 a month, would you be happy? Would you be smiling? Look at them. They're happy. You'd be happy. Now, that $1,500 is an after-tax payment. They're taking out money from a qualified fund. So they have to take out about $1,900 and pay state and federal income tax, depending on the state they live in, to net $1,500. So when we eliminated their monthly mortgage payment, they got to keep $22,000, $1,900 times 12, in their retirement savings. Oh my gosh. So now they don't have to take out $30,000 that they thought they'd have to take out. They only have to take out $8,000 initially to maintain their lifestyle. Not only that, so that extended the life of their savings. They're not going to run out of money under normal circumstances and life expectancy, but it minimizes their taxes. See, they were pulling out $22,000 that was going against their provisional income. So now we can minimize their taxes, maybe even lower their tax bracket in retirement. Eliminating a monthly mortgage payment in retirement has significant benefits. Now, I wasn't going to add this, but this is what I'm doing in my retirement. The question I asked earlier, since you're already making a monthly mortgage payment, to the viewer, if you had a choice, would you rather that payment to be mandatory or voluntary? What would you choose? Don, voluntary. Me too. So why would you choose a voluntary payment? Darius, why do you think people, if they had a choice in retirement, would choose a voluntary payment? And Carmen as well. What do you think some of the answers I hear are?
They choose voluntary because they have a choice. Having a choice gives you the ability to make alternative decisions with where you put your money, maybe into something that is revenue generating to grow your income.
Sure. Carmen, you want to add to that?
Yeah, I was just thinking about transferring a liability, the payment into an asset, exactly what Darius was saying. How can I make my money grow? But again, just having the option.
Or buying a life insurance.
Sure. I hear words like freedom, flexibility. I don't have to do it. Control, alternative investing, save more, sleep better. All of that. And so they tell you why. And then I say, so if we can turn your mandatory payment into a voluntary one, would you want to see how it works? And here's what it looks like. See, when you get a reverse mortgage, you can choose to make a monthly mortgage payment. Remember that line of credit? That's the green line. Every time you make a payment, that red line, your loan balance goes down. Just like a regular mortgage, but your line of credit goes up. So let's look at it here on the screen if you can see it. These folks, and this is Don and Shelly Grays, this is what we're doing, started out at $24,000 in line of credit, but they made a voluntary payment. So every time they made a voluntary payment, look what happens to their line of credit. It goes up, it grows. But if we go back, by the time we reach age 77, they no longer have to make a voluntary payment. They're just simply enjoying the ability to have this fourth bucket fully at work with them. So they've got a house that's free and clear. They've got a line of credit, and they have the other three buckets there: income, insurance, and investment bucket. So this is what I'm personally doing. I'm buying a house using a reverse mortgage. I'm going to work from age 63 to 83, and I'm going to make a voluntary payment of $2,500 a month for about 16 years. That's going to cause my line of credit here to grow and to be about $2 or $3 million. That's because I don't want my wife to have to worry about things. I don't know what the world is going to be like. So I'm using it in this way. That's a strategic way. I wrote another article. I write for Retirement Daily, 10 reasons to eliminate a monthly mortgage payment. And I unpack a lot of things in there. If they take the master class, we send all of that to them. Well, let me jump just on maybe one or two more. And Yahoo Finance said, there are 14 ways you're going to run out of money, or you could run out of money in retirement. And I put the list up there. Here it is on the right-hand side. And I'm not going to cover all that. You didn't have a long-term care plan. You didn't understand life expectancy. You didn't plan for high healthcare costs. 14 ways. Now, I can answer with this one chart, 13 of the 14. I can't answer number 10. You didn't consider fees. That has to do with your investment account. But I can answer all 14 of these. Let me go back. In 14 key signs that you may not make it. They're pretty extreme. But I want to talk about reducing income taxes paid in retirement. Now, I know Carmen and Darius, the work you've done, and even educating me on the ways to use life insurance that many people had never heard of. One of the impetuses is that income taxes are going to play a pretty important role. If you don't know how to manage them or mitigate them, it could be costly. Can you jump into your world for a minute and tell me how important it is for folks to understand the impact that income taxes are going to have?
Yeah, well, what we're really finding, Don, with everything that's shifting in the world, is how income taxes are really going to help or hurt in inheritances, right? So if we're not thinking strategically from the patriarchs and the matriarchs of the family of where our income is, be it retirement products, be it in assets like as real estate and things like that, as we're looking at the overall net wealth that our families have, it's really going to be detrimental to make sure that you understand what can happen when you're leaving an inheritance to your family, because we're finding that sometimes that the taxes become such a burden to your children and they're not able to maintain the wealth that you all have left for them. So that's why it's important. It's vital that you continue to consult with financial professionals who can help you understand the benefits of how to reduce your income taxes as much as you possibly can.
Right. And make sure you have those different buckets so that, because taxes are different depending on what bucket you decide to leave your family.
Absolutely. Most of the wealth, retirement wealth in America, is in 401ks or qualified
Yes.
plans,
Yes.
where you defer your taxes to somewhere down the road. But here's the deal: you've got a financial partner. You don't own that account by yourself.
Mhm.
You and Sam, Uncle Sam, own it together. And Sam says, now, when you want to take out money, you got to pay me first. I get paid first. And you say, well, how much do you want? What's your portion? He says, oh, I'm not going to tell you that until it's time to take it out. And you may say, well, that's not fair. How do I know that I'll have enough? Well, the point is you don't. The old adage is, when is $1 million not $1 million? When it's in a qualified plan or 401 or something. Because
That's a
you
good
don't
point.
because you don't know what you don't know.
Nope.
So
Right.
here I want to talk about just one strategy for your listeners. Remember, they're 52, and this is my second to last: reducing income taxes you pay in retirement. So if you could use your home to reduce the income taxes you pay in retirement, would you want to see how it works? Yes?
Yes.
How? Or what you're talking about, Willis? Absolutely.
Yes.
So Bob and Sally, 65, preparing for retirement. They've got $1 million in an IRA. They have a $650,000 home and no mortgage, and they want to reduce their income taxes. So one easy way to do that is the Roth conversion conversation. So Don, we want to move taxable dollars to non-tax via Roth conversion. I said, well, work with your financial advisors to do that. So, but be careful. You don't want to do it all at one time, because the tax hit is going to be enormous. And they said, our advisor said, we can do it $100,000 a year and just stretch it out over 10 years. I said, well, that's fine. So the question is, where do we get the money? Because you take $100,000, that's going to come in as income tax or taxable. Where do we get the money to pay the income tax on the conversion? Do we take it from the asset itself, meaning we don't roll over 100,000, we roll over 78? Do we take it from some other asset? Or what's the benefit of using this reverse mortgage line of credit? Darius, is what you said. Now we've got options. Now we've changed the conversation and said, let's consider this. So they had a reverse mortgage line of credit of $194,200. Notice it's growing, $14,000 a year. So they roll over $100,000 the first year, and the taxes are $22,000, but they pay that from their reverse mortgage. So they do this for 10 years. Let the reverse mortgage line of credit grow, roll over $100,000, pay the taxes. If that's invested at 8%, 10 years later, they no longer have any money in the taxable account. It's all tax-free. It's about $1.7 million. That changes not only their life, but their legacy and taxation. Well, that was a simple way. And I said, now, I'm not saying it's the right thing to do. I'm saying it's the right conversation to have.
That's beautiful.
So finally, add new dollars. Mark and Barbara here, Mark and Barbara here. I probably ran out of clip art here, so some people may get duplicated.
It's okay. We can pause. We can do your pictures.
No. They have a $600,000 home, and they've got a $100,000 mortgage, letter B. Now, whenever someone has a mortgage, the first question is, what would retirement be like if you didn't have to make a monthly mortgage payment? The second question is, since you're already making a monthly mortgage payment, if you could turn it, if you had a choice, would you rather be mandatory or voluntary? Those are right away, whenever you see that, that's the question to the viewers. So they said, listen, we want to move. It's a big house. I said, great. They sold their house. They paid off their existing mortgage, and they've got $500,000 left in proceeds. And I said, what if you buy a $400,000 home? Now, you can buy whatever house you want with the heck for purchase, but a $400,000 home. They said, great, we'll just take this $500,000 we have in proceeds and buy it. I said, wait a minute. Do you want to lock up the majority of your proceeds in brick and mortar? What happens if your home loses value? What happens if you need to pull that money out down the road? So they did a reverse mortgage on this home. Now watch this. The reverse mortgage made available to them $160,000 on their new home. Nice. Their new home. They've not even moved in yet. And so now I subtract that, their down payment, they've got to bring $240,000 to move into their new home. Well, they sold their home. They brought $240,000 from the proceeds. Look what happened. They've got $260,000 left over in cash after they sold their home. The new home, they have no more monthly mortgage payments, and they've got this money. We've absolutely rehabbed their retirement. So they show up at their advisor's office. I said, listen, go see Carmen and Darius. They'll get a kick out of this. Take $260,000, put it in a duffel bag, all singles, and just go show up at their office, and just plop it on the floor and open it up, And their eyes will get real big, and they'll say, "What is that?" They say, "Well, that's money. I want you to do something with it." They'll say, "Is it legal?" Say, "Oh, it's legal." And they say, "Where'd you get it?" Now watch this. Proceeds from the sale of my house. Now, normally you're not using the reverse mortgage proceeds to buy a product. That's going to be frowned upon, but you're not using the reverse mortgage. You would have gotten this money if you moved into an apartment, if you got a traditional mortgage. This is just proceeds from the sale of your house. What would retirement be like, those who are watching, if you were able to add another $260,000 back to your retirement savings?
Freedom.
Oh my gosh.
Freedom.
What a joy. What a joy. So we talked about in our mini masterclass, it's just a mortgage. It's not new, it's not dangerous, it's not spooky. It's not a last resort. Waiting until the end is the worst way to use a reverse mortgage if you're planning to stay in your home. And then we talked about it's more than a television commercial. These are critically important things. And then I'm going to take a few questions, but it's not for everyone.
Yeah.
I said that earlier. If I've told 13,000 people it's not for you, but I've told 3,000, it's absolutely something you should pursue. So where do we go from here? If you're watching this, say, "Don, this is good. Do I have any next steps?" Well, it's not for me. It might be for me. But if it is for you, I want to encourage you to do a few things. Number one, watch the Housing Wealth Masterclass. You can see this in its entirety. You can stop, pause, rewind. Go there, and that will help you to get in contact with me. And then schedule a discovery call. Find out how much money you can qualify, what strategy works best, and answer any specific questions you may have. And that's what I want to leave you with. Now, we'll take questions wherever you want to go. Carmen and Darius, I've finished my mini masterclass.
Beautiful. Amazing, amazing content. So one thing that I want to share with the Wealth Nation audience for you all to know, like we always say that we never recommend people if we haven't vetted them ourselves. So we actually did the masterclass, Darius and myself, and we did this also with my mom because my mom is a candidate, like I said, for example, and we've met with Don and his team and we completely vet, everything that they've done. So that's why we wanted to bring this to our channel because we just recognize how much freedom, going back to that key buzzword today in this presentation, how much freedom we can bring back to our families. And a lot of times we just don't know what's available to us. So that's why it was important for us to have this conversation today.
Right. So you mentioned that you speak with or you've spoken with over 16,000 people and only work with about 3,000. So you work with about 18% of the people that you connect with. Mm-hmm. Why wasn't it an opportunity for the 82% of the people that it didn't quite work out for?
Darius, when you say it like that, it feels like I'm really a failure.
You got to bring the engineer in to bring the numbers in, right?
Oh my gosh. And Emily, remind me not to do this again with Darius.
No, it's the 80-20 rule. It falls completely into the 80-20 rule, right? Doesn't it?
When I started, I was president of a nonprofit. Darius, if I forget the question, bring me back.
Okay.
And my sister called me. I was Habitat for Humanity. She called me and said, "Look, brother, I've got a business opportunity." She's 14 years older than me. And I said, describe it to me. And I said, "Oh, no, that's it. You're going to jail. You're taking old people's money in houses. I don't want anything to do with that." And so I poo-pooed. I said, "Don't talk to me about this again." And she says, "Well, you like helping people. You can help people and you can earn a good living and you don't have to be poor." Mm-hmm. I said, "I'm not poor." She said, "You're very poor." And I told her this. I said, "Well, the Lord will provide." And my big sister, Michelle, said, "He has. He's provided you with a big sister and a brain. You should listen to her." Well, a year later, I circled back and I called. I said, "Well, let me look into this." It took me a year. And so I called. There were 5 agencies that did housing counseling, reverse mortgage counseling. I called all 5. I got breakfast meetings with 3 of them. I sat down. I said, "What's the aha, the gotcha, the fine print?" And then HUD had a home ownership center in Philadelphia, the Wanamaker building downtown. I called them, sat with Fannie Mae, called AARP. And I did all I did because the Book of Life says a good name is to be preferred than great riches. So I didn't want to just do stuff. I had a name. I wanted to make sure I could look Mr. and Mrs. Jones in the eye or Renee's mom in the eyeball and say, if it's not for you, it's not for you. Right. And so I did all that research, Darius. And I came away saying, my gosh, for the right people, this is a game changer. And I said, I will focus on always telling people the absolute truth. And if it's not for them, I'll tell them. I wrote an article and somebody said, Don, don't write that. I wrote an article called 16 Reasons You Should Pause Before Getting a Reverse Mortgage. I took 25 years and piled it into your question. Why would not someone not do it? Your listeners, 16considerations.com. It's online. Anybody can read it. You can go to www.16considerations.com and see my personal list of the 20% of people or 80% of people that didn't do it, according to Darius, Britt, 18.359 exactly. You can see.
We'll check the math.
You can see 16 reasons to pause.
Okay.
To say, hey, I'm not planning to stay in my home for at least the next 5 years. I'd say pause. Let's talk about that. I have a special needs child. And if something happens, I said, let's pause. Let's think about that. I don't have a strategy. I don't really know what I would do. Well, pause. Let's think about that. I give 16 reasons that I've told people to pause and think about. Maybe not stop, but pause. And again, when I wrote it, someone says, Don, I said, yes, I'm giving you all the reasons for free to say, because if it's not for you, don't do it.
Yeah.
Because you're gonna end up on the front of the newspaper saying, I'm so upset. I got that reverse mortgage and blah, blah, blah. And it's going to be bad. I said, I want your children to read it. I want everybody to know about it. So Darius, Mama said, tell people the truth and God will bless your business. And that's what I've done for 25 years. I tell people the truth. The only way people get to me, well, before I met you, I didn't have YouTube World, but I don't have a sign on my door. You can't get to me except through a financial advisor. And those are my primary clients. And for them, I say, it may not be for your client. I'm going to tell them. So when we do a discovery call, my team does the initial discovery call. And that's why the masterclass is so important. I want you to have information up front. And if it's not for you, don't do it. So Darius, 16considerations.com. Anybody can see why I say, well, let's give it a pause before we go forward.
Thank you very much. We're going to add that link in the description below. So if you want to click on that article and read it for yourself, it's going to be in the description below.
The other thing, Don, I just have one more question for you. So something that you kind of touched on, but I want to make sure we bring clarity to it. So for this product, is it only for individuals who are currently living in an existing home?
It is not necessarily. Because some people sold their home years ago and they moved to an apartment and now they want to move into a home and use the reverse for purchase.
Yes.
And so there's a caveat there, but typically the reverse mortgage, it has to be on your primary residence. So you have to be living in your primary residence. Now clients have 2 or 3 homes and so we'll do it on the primary residence. So somebody has to be age 62 or primary residence, and you have to have enough equity in your home to make sure we can get rid of any existing mortgages from you. So those are kind of the 3 things. But I had a person the other day says he was a professor at Harvard, and he says, I'm going to stay in Cambridge. Can my wife use the reverse for purchase and buy a home in South Carolina? And that's her primary residence. I'm going to stay here in Cambridge. Yep. And that's what they did. Beautiful. And so there are lots of strategies, lots of things to do. And again, it's more than a 60-second TV commercial, isn't it?
Right.
And so your Wealth Nation audience now says, wait a minute, can it do this? We only touched it. I teach 6 hours. I teach a whole course at the college. So we've touched the tip of the iceberg. And if you're watching or listening and you're saying, well, Don, I have a home, or Mom has a home, or Aunt Betsy has a home, and they've got a retirement that could be strengthened. Now, remember I said earlier, they may not need it. Don't think of this as something you need. Think of this as something you may want, because retirement's going to last longer, be more expensive and less predictable. And you want to have all your players on the field. You want to have all your assets working for you. Well, Don, this may be for my aunt. At a minimum, get some information. Find out how much your aunt or you, if you're listening, may qualify. It may not be a good fit. I've told you that. You can even vet it for yourself, but connect with us and let us at least give you an example. This is what you could have in your line of credit. I think that's fair. If you got if you've got an account somewhere, and listen, I'm not going to show the number here, but let me. So this is I'll put up real fast so nobody can.
They'll pause it.
Yeah, exactly. And zoom in on it.
Well, it's an embarrassing story, but years ago I was at Wells Fargo and they stopped doing reverse mortgages, got out of the business, and they rolled over my 401k somewhere, and okay, and I fine, great. I forgot about it. I absolutely forgot about it. And a few years ago, some folks called and they said, Don, what are you doing with this money you have? I said, money? I got money? Now, who are you? Let's vet it out. And what's my dog's first name? And then what's my shoe size? And we did all that, and it was true. And I said, I've got money? What do you think my next question was once I found out that it was true? What's
How
the
much?
next? How much do I have? That's right. That is right here on my desk. It's right here. And now I'm embarrassed to say it was substantial. And here's what I say to your listeners. Do you know how much money you have in your housing wealth? Do you know? It could be substantial. At a minimum, you may want to get that number. You may not want to do anything with it, but oh my God, at least find out what's in there. What's in there? I think that's fair to say.
Absolutely.
Yeah, absolutely.
Now, the last question that I'm going to ask Don, because I know people are all asking, how much does it cost to work with you, fees, all of that type of stuff?
It doesn't cost anything to work with me. I serve as the National Business Development Manager for the largest reverse mortgage lender in America. I'm not going to say the name, but it's a 130-year-old Fortune 300 company. I give leadership to a team about 200. And so it's a name you'll know and trust and recognize. And so for the discovery call and the consultation, there's no cost for that. I want you to know. So get the information. If you say, Donna, this is good. We want to go forward. Great. Our team works with you. I do right now. I currently do the case design for all of the clients. And there we give you everything, 96 pages, what the rates, terms, fees, costs, all of that. We cover it, but we never get there because I want to vet you out first. I learned this from Carmen and Darius. I want you to self-select. If you don't have a plan or strategy, this is not going to be beneficial, helpful to you, then you don't get to me. But if you say, man, this could be helpful. I want this reserve. I want to get rid of a mortgage. I want to mitigate some taxes. I want to strengthen Social Security, whatever. Then we walk through all of that when we get there. But that's a great question. Listen, no stone is left unturned. This is a federally sponsored program. There's more paper than you ever wanted. So for the engineer and Darius, we give you all of that. We give you all that.
Perfect.
Fantastic.
Thank you so much, Don.
Don, thank you so much for joining the Wealth Nation family today. We are just thrilled that you're here with us and that you've provided so much valuable information. So for those of you who want to get in touch with Don, click on all of the amazing links that we will leave below, because we want to make sure that we can change the world together and serve our families the best way possible.
Yeah, I'm sorry. I wanted to say something.
Please.
And I just wanted to thank you and Darius. And on one of your videos, and maybe it was a while back, and I hadn't seen it, you shared a very personal story about some things that had transpired in your life and then how it had shaped and shifted you. And it's very personal. And I want to tell you, it was very meaningful to me. Thank you for sharing parts of your life that are not hard, because there's so many folks like me that have tough situations. And sometimes we don't have a lot of hope. Sometimes I sleep too much or get a little depressed sometimes. And I think, man, this is hard. But then there are folks like you that will be transparent about hard things. And I just wanted you to know it makes a real difference. There are people listening and watching that may never get the chance to say that to you. And like me, I followed you for years. But I just wanted to say, while I had the chance, how appreciative I am of your life and your transparency.
Thank you.
Thank you, Don.
Thank you very much, Don. We really, really appreciate that.
Yeah, that means the world to us. Thank you. Good stuff.
Now, we talked today about retirement. This isn't the only Thanks to Don, we know this isn't the only bucket that we need to take into consideration as far as our retirement. So if you want more information on tips and tricks about retirement, check out our next video.
And remember, Wealth Nation, own your own lifestyle,
or someone else will.